Most people think of a bank as a giant safe. You hand over your money. They hold it. You come back later and take it out. It feels simple and free. But banks are not safes. They are businesses, and your deposits are one of their most valuable raw materials. Once you understand how banks actually make money, your everyday financial decisions start to look very different. At its core, a bank is a business that takes in money from one group of people and lends it out to another group. You deposit money and earn a small amount of interest. The bank lends that same money out at a much higher interest rate. The difference between what they pay you and what they charge borrowers is one of their biggest sources of profit. That gap is called the spread. This matters because it changes how you should think about your savings. The money sitting in your account is not just resting. It is being used. Banks lend it out, package it, and earn returns from it. They pay you a tiny fraction of that. Once you realize that your deposit is a tool the bank uses to make money, you start to ask better questions about what you are getting in return. To understand how it really works, picture a simple cycle. Customer A deposits money into the bank. The bank lends that money to Customer B for a home, a car, or a business. Customer B pays interest to the bank. The bank pays a small slice of that interest back to Customer A, then it keeps the rest as profit. This basic cycle repeats millions of times every single day. Let us look at a simple example. Imagine you deposit $10,000 and the bank pays you 1% a year. That is $100 in interest. The bank then lends a similar amount out at 6%. That is $600 in interest the borrower pays. The bank pockets the $500 difference for arranging the trust and managing the risk. Multiply that by millions of customers. A common mistake is to think the spread is the only way banks earn. Fees are another huge source. Account maintenance fees, overdraft fees, late payment fees, ATM fees, foreign transaction fees, and minimum balance penalties all add up. Each fee may look tiny on a single statement, but across many millions of accounts, these small charges quietly become a major part of bank revenue. There is also a hidden risk to ignoring how banks earn. Many people accept the first account they ever open and never compare options. Over years, low interest on savings and quiet fees add up to real money lost. The cost is invisible because it does not appear as a charge. It appears as growth that never happened and convenience you paid for without realizing. A useful way to picture a bank is as a giant traffic intersection for money. Cars are payments, salaries, deposits, and loans. The bank does not own most of the cars driving through it. It owns the lights, the signs, and the toll booths. Every time something passes through its intersection, it collects a small toll. The more traffic, the more it earns, simply for being the middle layer. A second key idea is how banks earn from credit cards. When you spend on a card, the merchant pays a small fee to the card network. Part of that goes to your bank. If you carry a balance, the bank also earns interest. Cards are profitable in two ways at once, which is why so many cards have generous-looking sign-up offers. The offer is paid for by future fees and interest. A practical example helps. Imagine a customer who uses a credit card and pays the full balance every month. The bank still earns from merchant fees. Now imagine another customer who carries a balance regularly. The bank earns merchant fees plus interest on the unpaid amount. The second customer is far more profitable to the bank, which is why credit products are often marketed so aggressively. Beginners often misunderstand the role of investment products banks offer. Wealth management, mutual funds, insurance bundles, and structured products are not just helpful services. They are revenue streams. Banks may earn commissions, advisory fees, or hidden charges built into the products. Some are great, some are average. The key is that you should evaluate them on their merit, not on the assumption that the bank is acting only as your guide. There is also a psychology angle. Banks earn the most from customers who are too busy, too loyal, or too uncertain to compare. If a fee feels too small to fight, most people accept it. If switching accounts feels complicated, most people stay. Banks are not unfair to design profitable systems. It is your job to design a profitable system on your own side, made of awareness and small careful choices. A simple practical rule helps protect your money. Read the fee schedule for any account you use regularly. Know what your savings rate actually is. Compare options every couple of years. Make sure you understand any product before signing for it. None of this is glamorous. But these small habits, repeated over decades, can quietly add up to thousands of dollars saved or earned that would otherwise have stayed with the bank. There are things to avoid. Do not stay loyal to an account purely out of habit. Do not assume a free account is truly free. Do not accept overdraft features without understanding the cost. Do not buy financial products from your bank just because they offered them. And do not ignore the small charges on your monthly statement. Awareness alone changes outcomes more than any complicated trick. A better habit is treating your bank like any other vendor in your life. You expect quality from your phone provider, your internet service, and your supermarket. You compare prices. You change when better options appear. Apply the same logic to your bank. Loyalty is good only when it is rewarded. If your account quietly underperforms for years, switching is not disloyalty. It is good personal finance. Over the long term, the way you interact with banks becomes a quiet wealth signal. A small improvement in savings rate, a few avoided fees a year, and one carefully chosen credit product can add up dramatically over a lifetime. People rarely lose to banks in one big mistake. They lose slowly, through years of choices that were never reviewed. A small amount of attention here pays for itself many times over. So here is the short version. Banks earn by lending your deposits out at higher rates, collecting fees, processing payments, charging interest on credit, and selling financial products. They are businesses with shareholders and goals. That is not bad. It just means that the customer who pays attention earns a better deal than the customer who does not. Knowing how banks earn is half the strategy. If you want to be financially strong, treat your bank as a service, not as a parent. Compare accounts. Watch the fees. Understand the products. Negotiate where you can. None of this requires being an expert. It just requires remembering that the bank is also trying to make money from the relationship, and the more informed you are, the more fairly that relationship works for both sides over time.